A discounted cash flow, DCF, is like estimating how much a river will be worth if you could sell every drop of water it will ever carry. First, you forecast the company's free cash flows, FCF, for a finite period, usually 5 to 10 years. Each year's cash flow, FCFF sub T, is projected based on revenue growth, operating margins, tax rates, capital expenditures, and changes in working capital. Next, you need a discount rate. Think of this as the interest cost of borrowing money to buy the river today. In M&A, we use the firm-wide weighted average cost of capital, WACC. The present value PV of each projected cash flow is calculated as PV sub T equals FCFF sub T divided by 1 plus WACC to the T. After the explicit forecast horizon, you must capture the value of cash flows that continue forever, the terminal value TV. The two common formulas are perpetuity growth model. TV equals FCFF sub N multiplied by 1 plus G divided by WACC minus G, where G is the long-run growth rate, often 2 to 3%. Exit multiple method. TV equals EBITDA a sub N multiplied by exit multiple, for example 8 times. The total enterprise value, EV, is the sum of all discounted cash flows plus the discounted terminal value. EV equals sigma from T equals 1 to N of FCFF sub T divided by 1 plus WACC to the T, plus TV divided by 1 plus WACC to the N. The DCF therefore translates future river flows into a single number you can compare to an asking price. WACC is the weighted average of the cost of each piece of capital, much like mixing ingredients in a cake where each ingredient contributes to the final taste. Cost of equity RE is estimated with the capital asset pricing model, CAPM. RE equals RF plus beta times RM minus RF, where RF is the risk-free rate. For example, 10-year Treasury, beta measures how volatile the target stock is compared to the market, and RM minus RF is the market risk premium. Cost of debt, RD, is the after-tax yield the company pays on its borrowings. You can take the yield on existing bonds or the bank loan rate, then adjust for tax, RD times 1 minus TC. Capital structure weighting uses market values, not book values, to reflect the true economic mix. E equals market value of equity, D equals market value of debt, V equals E plus D. Weight of equity equals A over V, weight of debt equals D over V. Finally, WACC equals E over V times RE plus D over V times RD times 1 minus TC. In an M&A, you often recalculate WACC for the combined entity, because the buyer may change the debt level or the risk profile after the deal. Example, if a target has 600 million equity, E, and 400 million debt, D, RE equals 12%, RD equals 6%, and the corporate tax rate is 25% then. WACC equals 600 divided by 1,000 times 12% plus 400, divided by 1,000 times 6% times 1 minus 0.25, equals 7.2% plus 1.8% equals 9.0%. The terminal growth rate G and exit multiple are the two last step levers that often swing a discounted cash flow valuation the most, similar to choosing the finishing paint color for a house. It does not change the structure, but it changes the final impression. Terminal growth rate G should reflect the sustainable growth of the whole economy, not the high growth phase of the target. Analysts typically use 2 to 3% for mature markets, or a slightly higher figure if the target operates in a fast-growing sector with a durable competitive advantage. A too high G, for example greater than WACC, makes the formula explode, signaling a mistake. Impact in the perpetual growth formula. TV equals FCFF sub N times open parenthesis 1 plus G close parenthesis divided by WACC minus G. A 1% increase in G raises TV by roughly open parenthesis G divided by open parenthesis WACC minus G close parenthesis proportion. For a WACC of 9% and G of 2%, raising G to 3% increases TV by about 1/6, approximately 16.7%. Exit multiple. This method backs out the terminal value from an observable market metric, for example EBITDA times 8. You pick the multiple by looking at recent comparable transactions or public peers. The justification is that buyers in the market are already paying that multiple, so you align the model with market reality. Impact: if EBITDA sub N equals $120 million, and you apply an 8 times multiple, TV equals $960 million. Using a 7 times multiple drops TV to $840 million, a 12.5% reduction. Choosing between the two often depends on data availability and the comfort level of the analyst. In practice, many MBA exams ask you to calculate both and discuss why one may be more appropriate for the case at hand. Sensitivity analysis is like testing a car on different road conditions. You keep the engine the same but see how speed changes on a highway, a hill, or in rain. In a DCF, you vary key inputs WACC terminal growth, revenue growth to see the range of possible values. The step-by-step matrix. Step 1, pick a base case. For example, WACC 9%, G2%, revenue CAGR 5%. Step 2, define low to high ranges. WACC 8 to 10%, G1 to 3%, CAGR 3 to 7%. Step 3, build a two-dimensional table. For example, rows equal WACC, columns equal G. Fill each cell with the resulting enterprise value. Table columns, blank G1%, G2%, G3%. Separator row. Row WACC 8%, X1, X2, X3. Row WACC 9%, X4, X5, X6. Row WACC 10%, X7, X8, X9. The middle cell X5 is the base case. The corners give the worst case and best case valuations. Scenario analysis goes a step further by linking inputs. A high-growth scenario might pair a low WACC because the buyer can cheapen debt with a higher terminal multiple, while a downturn scenario uses higher WACC and lower growth. In exam problems, you are often asked to present a 3x3 matrix and interpret the range. For example, the enterprise value varies from $850 million to $1.15 billion, indicating the valuation is most sensitive to the terminal growth assumption. Choosing comparable companies is like picking teammates for a relay race. You want runners with similar speed, stamina, and track conditions. The goal is to find firms that share the same economic drivers so that multiples are meaningful. Industry definition. Use NAICS or GICS codes to narrow the universe. For a tech hardware buyer, you might start with computer and peripheral equipment. Size, filter by revenue plus or minus 30% of target or market cap, because scale affects cost structure and valuation multiples. Growth, look at recent CAGR of revenue and EBITDA. Companies growing faster than the target may command higher multiples, adjust accordingly. Geography, operating in the same region matters due to regulation, labor costs, and currency risk. A European target should be compared mainly to other European firms unless the M&A is global. Practical steps. Step 1, pull a list of public comparables from Bloomberg or Capital IQ. Step 2, apply screens for industry revenue range, EBITDA margin band, and country. Step 3, review each candidate's recent news to confirm comparable business models, subscription versus license. By being disciplined, you avoid the street-light mistake of using the most convenient companies rather than the most comparable ones. Valuation multiples are the shorthand way of saying the market values each dollar of earnings or sales at X dollars. Think of it as a price per pound tag at a grocery store. The key multiples is EV divided by EBITDA equals enterprise value divided by EBITDA. It removes financing and tax effects, giving a view of operating performance. EV divided by revenue equals enterprise value divided by revenue. Useful for early stage or loss-making firms where EBITDA is negative. PE equals market capitalization divided by net income, or EPS, focuses on equity holders and includes tax and interest effects. Normalization adjustments. Non-recurring items. Add back one-off gains or losses to EBITDA or earnings so the multiple reflects sustainable performance. Capital structure differences. Convert market cap and net debt into enterprise value for EV multiples. Enterprise value equals market cap plus debt minus cash. Share count adjustments. Use diluted shares for PE to capture potential dilution. Accounting differences. Rate EBITDA to a common basis, for example IFRS versus US GAAP if needed. Example calculation. Target, revenue 500 million, EBITDA 80 million, net debt 150 million, market cap 600 million. Enterprise value equals 600 million plus 150 million minus 30 million cash, which equals 720 million. Enterprise value divided by EBITDA equals 720 million divided by 80 million, which equals 9.0 times. Enterprise value divided by revenue equals 720 million divided by 500 million, which equals 1.44 times. Assume net income 40 million, shares 30 million, earnings per share equals $1.33. Price to earnings equals $20 divided by $1.33, approximately 15 times. These multiples can then be compared to the peer set. When you move from a public comparable to a private transaction, the price usually includes extra bits that reflect the buyer's added control and expected synergies similar to paying a premium for a house, because you can remodel it your way. Control premium. The buyer acquires 100% of the shares, gaining decision-making power. Empirical studies show a typical premium of 20 to 30% over the public market price. To adjust, multiply the comparable's equity value by 1 plus premium. Synergies, expected cost savings, or revenue enhancements from combining operations, for example, eliminating duplicate HR functions. Quantify the net present value of synergies, synergy NPV, and add it to the enterprise value. Transaction-specific factors. Financing structure. If the deal is heavily leveraged, the buyer may demand a lower price because of higher risk. Regulatory antitrust risks may lower the multiple. Geographic spread. Cross-border deals may incorporate a discount for integration complexity. Adjustment formula. Adjusted EV equals comparable EV times 1 plus control premium plus synergy NPV minus transaction costs. Example, a comparable EV of $1.0 billion, control premium 25% equals $1.25 billion. Expected synergies of $100 million, NPV equals $1.35 billion. Subtract $20 million advisory fees equals $1.33 billion final adjusted EV. These tweaks bring the multiples closer to what a buyer would actually pay in a negotiated transaction. Reconciling the two approaches is like blending two flavors to create a balanced dish. Neither DCF nor multiples alone tells the whole story, so analysts usually assign weights and calculate a composite value. Common weighting schemes. 50-50, equal weight to DCF and market-based multiples when both are considered reliable. 70-30, favor DCF when the target has stable cash flows and reliable forecasts. Favor multiples when the market is more informative, for example, volatile industries. Dynamic weighting, use the inverse of the variance of each method's range. The method with a tighter range gets a higher weight. Composite value calculation. Composite value equals W1 times value DCF plus W2 times value multiples, where W1 plus W2 equals 1. Practical example. DCF gives $950 million, range $880 million to $1,020 million. Comparable EBITDA average yields $1,050 million, range $970 million to $1,130 million. Assume a 60-40 weighting, DCF higher confidence. Composite equals 0.6 times $950 million plus 0.4 times $1,050 million equals $570 million plus $420 million equals $990 million. Analysts will also disclose the rationale. The DCF is given higher weight because the target's cash flows are predictable, whereas the market multiples are broader due to high valuation dispersion among peers. The final transaction price may be further adjusted for negotiation dynamics, but the composite provides a defensible quantitative anchor. MBA tip: always show the two separate valuations, the chosen weights, and a brief justification. Exam graders love the transparent reasoning. Cost of equity, RE equals 3% plus 1.2 times 6% equals 10.2%. Cost of debt, assume existing debt yields 5%. After tax RD equals 5% times open parenthesis 1 minus 0.25 close parenthesis equals 3.75%. Capital structure, equity equals $300 million, debt equals $50 million, which gives enterprise value $350 million. Weights, WE equals 300 divided by 350 equals 0.857, WD equals 0.143. Weighted average cost of capital equals 0.857 times 10.2% plus 0.143 times 3.75% equals 8.74%. Project cash flows over a 5-year horizon. Year 1 revenue equals $224 million, which is 12% growth. Earnings before interest, taxes, depreciation, and amortization equals 30% times 224 equals $67.2 million. Continue growth for years 2 through 5. Free cash flow to the firm equals earnings before interest, taxes, depreciation and amortization minus taxes minus capital expenditures minus change in working capital plus depreciation. Compute each year. Students can show 1 year as an example. Terminal value using a perpetuity growth rate G equals 2%. Terminal value equals free cash flow to the firm in year 5 times open parenthesis 1 plus G close parenthesis divided by open parenthesis weighted average cost of capital minus G close parenthesis. Discount all cash flows and terminal value at 8.74% to get a discounted cash flow value approximately $950 million. Illustrative. Comparable valuation. Earnings before interest, taxes, depreciation, and amortization in 2023 equals $60 million, which gives an enterprise value of 10 times 60 equals $600 million using the EV over EBITDA multiple. Revenue in 2023 equals $200 million, which gives an enterprise value of 5 times 200 equals $1 billion using the EV over revenue multiple. Take the average enterprise value of $800 million. Adjust for a control premium of 20% by multiplying $800 million by 1.2, resulting in $960 million. Add synergies of $20 million to get $980 million. Reconcile, for example, 60% discounted cash flow and 40% multiples. Composite equals 0.6 times $950 million plus 0.4 times $980 million equals $965 million. Conclusion: the fair enterprise value lies around $960 to $970 million. The analyst would recommend an offer price slightly above the composite to reflect negotiation leverage. Why this approach? The discounted cash flow captures target co's strong, predictable cash flow stream, while the multiples reflect market sentiment and incorporate the control premium and synergies that a buyer would expect. Presenting both gives a well-rounded, defensible valuation, exactly what